All right, let's pull back the curtain on one of the most powerful, but, often kind of misunderstood concepts in investing, how you actually manage your portfolio's risk. And the secret, as you're about to see, isn't just about picking good stocks, it's all about how they interact with each other.
So let's start with the big question. When you look at your collection of investments, your stocks, your bonds, whatever, how do you actually put a number on the risk? How do you measure its potential for those wild, stomach-churning swings?
Well, the technical answer, which comes from some pretty brilliant Nobel Prize-winning theory, is a metric called variance. The easiest way to think about it is as your portfolio's financial wobble. A high variance means its value is swinging all over the place, while a low variance means it's a much more stable ride. This is our main way of measuring risk.
But, and this is a big but, calculating that total portfolio wobble isn't as simple as just adding up the wobbles of each individual stock. And that brings us to the real secret ingredient we're talking about today, covariance. Here is the absolute best way to picture this. Imagine all your stocks are dancers on a stage. Your risk isn't just about how wildly each one is flailing their arms around. No, it's about whether they're all moving in sync, or if their movements are actually canceling each other out. Covariance is the thing that measures how they dance together.
Okay, so let's break down this dance. On one side, you've got positive covariance. This is when your assets all move together. When the market's up, they're all up. When it's down, they're all down. But on the other side, you've got negative covariance. And this is the magic part. These are the assets that tend to move in opposite directions. When one zigs, the other one zags.
And that opposition, that zagging, when the other asset zigs, that is precisely how we can actively and powerfully reduce the overall risk of our portfolio. Let's look at exactly how this works.
Now, hey, don't worry, we're not about to dive into a deep math lecture. But just look at this formula for the total risk. That's the variance of a simple two-stock portfolio. The first two parts are just the individual risks of each stock. But then there's that third piece at the end.
That last part of the equation, that's the whole point, the covariance term. Just think about it for a second. If your assets move in opposite directions, their covariance is negative. That makes this entire term a negative number. You are literally subtracting risk from your portfolio's total. It's not just diversification, it's practically risk cancellation. And as one analysis puts it, if you have two assets that are expected to perform pretty much the same, but they have a negative covariance, splitting your money between them actually makes your total investment safer than putting it all in just one of them.
So, how do we blow this up into a bigger strategy? Well, this principle shows that true diversification isn't just about owning a bunch of different things. It's about owning the right combination of things. This is what diversification with purpose really looks like.
The idea is actually really simple. The lower the covariance, the better the diversification. You're actively on the hunt for assets that don't dance in sync, because their opposing movements are what create stability for your portfolio as a whole.
So what does this look like in the real world? Well, you might pair a high-growth tech stock with a super stable utility stock. Or you could combine stocks from completely different industries that get hit by different economic forces. Even better, you can mix different asset classes entirely, like pairing your US stocks with international bonds.
So, the key takeaway is this. The ultimate goal is to build a team of assets where each member helps absorb the shocks that hit the others. So when one part of your portfolio is having a really bad day, another part is having a pretty good day, and the net result is a much, much smoother ride for you.
Now, this all sounds great in theory, but as you can probably imagine, calculating the covariance for every single pair of stocks in a big portfolio sounds, well, let's be honest, it sounds incredibly difficult. Luckily, we don't have to do it by hand anymore.
Exactly. I mean, if you have just 20 stocks, you have to calculate 190 different covariance pairs to build what's called a covariance matrix. It's a massive task, and it's the main reason this powerful strategy wasn't really accessible to everyday investors for a long, long time.
But today, technology has totally changed the game. The workflow now is incredibly simple. You pick the assets you're interested in, you plug them into a portfolio building tool, and it does all the heavy lifting for you, giving you an optimized mix almost instantly.
For instance, modern apps can take this really complex Markowitz model, run all those crazy calculations in the background, and help you build an efficient portfolio that's perfectly tailored to how much risk you're comfortable with. What once required a whole team of analysts can now be done in minutes on your phone. So we'll leave you with this final thought to chew on as you look at your own investments. Are they truly diversified with assets that actually buffer each other? Or are they just a collection of different company names that all dance to the very same tune?
Understanding covariance, that's the key to knowing the difference.